Hey there. Welcome to ShareTreck, where science meets investments, and I'm your host, Raj. Friends, today I'm going to show you why I think Tesla might be one of the most dangerously overvalued stocks in the market right now. We will dive into their shocking 66% profit decline, how BYD is absolutely crushing them in Europe with 359% growth rate, while Tesla dropped 49%. Plus, I will reveal Tesla's new 29 billion CEO pay package that could devastate the stock price, and why their 200 times earning valuation makes absolutely no sense anymore. By the end of this video, you will have a complete picture of why I think this former market darling could be setting up for a massive fall. Now, before you hit the dislike button, thinking I'm just another Tesla hater, let me show you the hard data. Tesla is trading at a PE ratio of nearly 200. That's higher than most growth stocks during the dot-com bubble. But here's the shocking part. Tesla isn't growing anymore. In fact, it's shrinking fast. The core problem is that their EV business is deteriorating. Let me start with Tesla's bread and butter, electric vehicles manufacturing. This is where Tesla makes its money, and this business is in serious trouble. Just look at the numbers from this year. Tesla's operating income in Q1 2025 dropped 66%. That is two-thirds compared to the same quarter last year. Their operating margin fell to just 2.1%. For a company that's supposed to be the future of transportation, these are pretty scary numbers. But it gets worse. In Q2, Tesla's automotive revenue dropped from 19.9 billion to just over 16.7 billion year over year. That's a massive decline for what's supposed to be a growth company. Now, Tesla bulls will tell you this is just a temporary blip, but I think there is something more fundamental happening here now. Tesla has built its early success on two things: being first to market with premium EVs and regulatory credits. Both these advantages, in my opinion, are disappearing. Let's talk about regulatory credits for a second. These are basically free money that other automakers pay Tesla because they can't meet emission standards. Since 2019, Tesla has collected $11 billion, and that is billion with a B. And all that money, 11 billion, came from these credits. But this gravy train is coming to an end. In Q2 2025, Tesla's regulatory credit revenue fell 51% compared to last year. And from Q3 onwards, the EV credits are totally going to disappear. As more automakers launch their own EVs, they won't need to buy credits, and the big beautiful bill also eliminated it. This $11 billion revenue stream is going to zero, and Tesla hasn't figured out how to replace it. But the real knockout punch is coming from China, specifically from BYD. While Tesla was busy with Twitter drama and Cybertruck delays, BYD has been quietly eating their lunch in the global market. The numbers are staggering. In Europe, BYD's sales volume grew 359% in April, while Tesla's dropped 49%. In Britain and Germany, two of Tesla's strongest European markets, Tesla sales fell by more than 55%, while BYD is absolutely soaring. This isn't just a temporary market shift. BYD is offering comparable electrical vehicles at significantly lower prices. They have got better supply chains, lower manufacturing costs, and they are not distracted by social media companies or space exploration. When I look at the valuation, BYD trades at a PE of around 14. Ford is at 14. These are reasonable valuation for auto companies. Now, before I go further, I would like to say that Elon Musk's venture into politics has definitely taken a toll on its market internationally, except for Norway, where they are doing exceptionally well. I would say that, most people might be wondering, why is Tesla still valued so high if it has got all these problems? I think the answer is artificial intelligence and robotics. Tesla bulls believe the company is really an AI company that happens to make cars. They think full self-driving and robotaxis will justify the massive valuation. But here's where things get really interesting. Elon Musk, Tesla's CEO, seems more interested in his other AI company, XAI, than he is in Tesla's AI development. I found some fascinating evidence of this. Internal emails from NVIDIA show that Musk told the chip company to prioritize GPU shipment to his personal companies XAI and X ahead of Tesla. Think about that for a second. Tesla ordered and paid for these GPUs to develop their self-driving technology, but Musk redirected them allegedly to his other companies instead. This is a massive conflict of interest that Tesla shareholders should be furious about. Tesla is funding the competition to its own AI development. And speaking of self-driving, let's be honest about where Tesla really stands. They have been promising full self-driving for years. Elon said Tesla would have 1 million robotaxis on the road by 2020. That was 5 years ago, and we are still waiting. The robotaxi event they held in Texas generated more skepticism than excitement. Tesla is still relying purely on cameras for autonomous driving, while their competitors are using advanced sensor fusion with LiDAR and radar. There is even a class action lawsuit against Tesla for misleading customers about their self-driving capabilities. And I think that's another drag on the stock price. And I think robotaxi is not happening anytime soon in the real sense of the term, if ever. But here's where things get truly outrageous. Tesla's corporate governance is what I'm talking about. The board of directors is supposed to represent shareholders and keep management accountable. I think instead, I think Tesla's board acts more like Elon Musk's personal approval committee. Here's the perfect example that should terrify every Tesla shareholder, at least it terrifies me. Elon Musk had a $56 billion compensation package that got struck down by the Delaware courts because it was excessive and improperly approved. The court basically said that corporate governance was malpractice. So what did the Tesla board do in response? They doubled down. They moved to incorporate in Texas, and now they have created a brand new $29 billion package for Elon Musk. Think about that for a second. $29 billion. Tesla has made $35 billion in cumulative profits since the company was founded. That's everything, net of all the early losses that they have. This compensation package represents 82% of every dollar Tesla has ever earned in its entire corporate history. But here's the kicker. The new package doesn't require Musk to hit any performance target. It doesn't require him to commit a specific amount of time to Tesla. He literally just has to not quit for 4 years. That's it. Meanwhile, Musk is openly threatening to take Tesla's AI development to other companies unless shareholders give him more voting control. He's essentially holding the company hostage while the board hands him nearly a third of $1 trillion. If this compensation gets approved and paid out, it will be one of the biggest wealth transfers from public shareholders to a single individual in the entire corporate history. And for what? The privilege of keeping a CEO who is already dividing his attention between 6 other companies and controversy, that is politics. So here's where we stand. Tesla is priced like the next revolutionary tech company, but it's performing more like a struggling traditional automaker, in my opinion. Let me summarize what we have covered. The core EV business is contracting, with operating income down 66% and auto revenue falling down by billions. The regulatory credit gravy train that provided $11 billion since 2019 is ending. Competitors like BYD are systematically taking market share with superior products at lower prices. The AI and robotics narrative that support the 200 times earnings valuation, it's largely fantasy. The CEO is more focused on his personal AI company than Tesla's development. He's literally redirecting Tesla's resources to competing ventures. Full self-driving remains years away despite a decade of promises. And the corporate governance board seems to be a little bit broken. The board prioritizes keeping Elon happy over creating shareholder value, in my opinion. Approving compensation packages that would consume 82% of the company's lifetime profit. I have not included the $11 billion that they got as EV credits, which is part of the total amount that we are talking out here. So if we take that out, then it will be even more than 82%. The 29 billion will be even more than 82%. Tesla succeeded when it was the only premium EV option. The monopoly is over. BYD, Mercedes, BMW, and others offer competitive or superior electric vehicles. Tesla is becoming just another car company. And car companies don't deserve 200 times multiple earnings. The math doesn't work anymore. This stock is setting up for major correction in my opinion. I'd love your perspective. Do you think I'm missing something critical about Tesla's future prospects? Or does this analysis change how you view the stock? Please drop your comments in the comment section. I genuinely read every single one and often respond personally to each and every comment. Well friends, I have one request for you. Please press the like button because it helps YouTube send out this video to other people like you who may want to see this video. Help us grow the channel and the community. Thanks and have a great day. Bye for now.